Hey everybody, Michelle with Cressivo here. Welcome to the daily live stream where we talk all about options, using options to create income for yourself on a regular basis, preferably every week. That's my favorite. If you're here for the first time, welcome. And if you're a returning user, welcome back. So we're going to talk about the positions today, and I'm going to go through questions as we always do. This is a great opportunity to ask questions live and get the answers live, and we can talk back and forth. I have my iPad here where I'm looking at your questions, and so my intention is that you guys become better traders and learn additional skills. Sometimes, oftentimes actually, we don't know what we don't know. And even if you've been trading for a while, there's always something that you're probably going to hear and say, I never really looked at that, or I never looked at it that way before. And that's the intention, is to help you not just make money, because anybody can make money when the market goes up, believe me. The real finesse or the real magic happens in risk management and not losing your money. So let's go through that. So first we're going to go through the positions, and we're just going to get a quick outlook on what we have, right? Because I have made a couple of changes. I have my 100 shares of AVGO much lower than where I bought the shares at, right? So I bought the shares at 477, and right now AVGO is only 386. So I do have, and let's talk for a moment about the big difference between paper loss and real loss, or paper gain and real gain, because there's a marked distinction between the two. And if you guys have questions, throw it up in the chat so I can address those, because I want you guys to make sure that you understand. So right now, because AVGO is trading so much lower than where I bought it at, I have this paper loss of about $9,000. But let's see how much I've made in AVGO since I've started trading options on it. So I'm going to look at the realized gain, because that's the most important thing, right? That's what I've put in my pocket, and I'm going to sort it by just that one ticker, right? So I'm just going to put AVGO in here. Now this is since I started this particular account. So even though AVGO is down $9,000 on paper, I bought it here and it's down to here, I've still made this amount of money, almost $3,000, $2,800 in realized gains trading that stock. So here's how you want to look at options. It's so different than let me just trade some stock. And first of all, it's broken in so many different ways. But first of all, most people buy stock. So that means you only make money when it goes up. So you don't make money when it stays flat. You don't make money when it goes down. You only make money when it goes up. So that's number one, a fundamentally kind of, I want to just say broken system, right? And secondarily, on top of that, you actually don't make any money in your pocket, because that's what's important, the cash you put in your pocket, until you sell the shares. But when you trade options, like I sold all these different calls, I sold the initial put or a put a while back, and then I have all these call contracts where you're able to lock in those gains as you go. This was the first one that I did. I think I originally did this trade as a buy 100 shares, sell a covered call. And that's a good strategy sometimes when the market's trending upward or that ticker is trending upward, right? I prefer, generally speaking, to sell a put first, because I think it's always better to drive cash off of cash, drive income, cash flow off of cash in your pocket, rather than tying up money in a stock. Because look at what happened. Right now, I still have this AVGO, and I've had it for a while. But what I've been doing is just selling calls underneath the basis. So I don't generally recommend that, because here's the thing. If you sell a call with a strike price less than what you paid for the shares, and those shares get called away, you're going to recognize a loss. So you really don't want that to happen. I've been doing it in short-term pieces. So like, for example, I had one that expired yesterday and I locked in that gain. Now I have this other one that's going to expire tomorrow. So I sell a call pretty far away from where it's trading, but still underneath my basis, just to be able to take in some income. Like this one, I took in 51 bucks. That way I'm just not sitting on my hands. Now, ideally, what you want to do is you want to sell another put, because as your stock comes down, it's still a great stock. You want to sell another put and be able to, number one, take more cash in. And then number two, if you buy the shares, then you sell a call to that particular lot, right? So that's what we're doing with Oracle as an example. And actually, that's also what we're doing with SMCI. I did some more SMCI this morning. So let's look at SMCI briefly. So I have 400 shares, right, that we see here, with an average cost for all those 400 shares, $36.93. But I had originally bought 100 at $47.61, we see right here, and then another 100 at 45. So those are kind of high. And then I bought more after at $26 and change right here, $28 this morning I bought these. And then what I do is I sell a covered call to that lot. So in other words, I sold this, I bought these 100 shares at $26 and change, and then I sold a $27 call for $86, right? So what's going to happen if SMCI rather closes over $27 tomorrow? Those shares, this particular lot right here, will go. So it gives you an opportunity. This is why you want to just focus on a handful of tickers, because you want to keep cash on the side and just keep hitting and hammering those specific tickers to keep churning income off of that stock, right? Off of that company. And I did the same thing here. I bought these 100 shares at $28.01 this morning, actually, and then I sold a $28.50 call for $51. So here's the thing. Like, it puts me in a position where, okay, tomorrow, I don't care where SMCI goes. I don't care if it goes higher. I don't care if it goes lower. I don't care if it stays the same. And that's how you want to think about all of your trading in those terms. Because listen, we can't like predict where it's going to go. Nobody can predict. Like, if you hear people say that, that's not accurate. Like, they're just saying that. Nobody knows, right? And so what we want to do is create income no matter where it goes, because I want to make money regardless, right? So if it goes higher, cool, I'll sell my shares and I'll tag it to that particular lot. So I'll make a couple dollars on the capital gain, but most importantly, I care about the premium that I made. So I keep the premium. And then if it doesn't go higher, if it stays flat or goes down even, that's okay too, because I still keep the premium, and then I sell another call on Monday. So the game, I guess, if you will, is just trading the same tickers over and over again and selling puts and calls. And it is that easy. It can be as easy as you make it, or it can be as hard as you make it. I like the easy way. I don't be looking at like computer screens all day or looking at charts. I look at a 1 year chart. I want to see like kind of where it's been throughout the past year. I look at gaps in the chart, like if it opened significantly higher than where it closed previously. We've gone over some of that in these videos. But as a general rule, I'm not watching the news. I'm not looking at what analysts are saying. I'm not looking at, somebody had mentioned in a YouTube comment previously, when earnings comes out, like what analysts anticipate, earnings guidance. I'm not looking at all that stuff. I'm not looking at any of that stuff. I want to make it easy for me. And all I care about is making income. So basically that's what we're doing. So that's kind of, the tickers that I wanted to highlight. And when it comes down to like, well, what's the portfolio value? That's not relevant for me. That's like, okay, well, if I liquidated everything, how much money would I have? That's more or less than where you started. I really don't care about that. Here's the things that I care about. This is a margin account, so I care about like, where can I get a margin call? Because that's important to know. So that's what this app will show me. And then I also care about, what's my realized gain? How much have I taken in income? And here we see almost $5,600 in cash that you put in your pocket. Now let's go through some questions. ET Phone Home says, I have been assigned stocks similar to AVGO, which had dropped a little over $100 to this date. I still sell covered calls that's underneath my cost basis to get the premium, but not close enough to get assignment. So that's what we're talking about. So that's kind of, I think what you're saying is what we're talking about here, where I've been selling these calls. You just have to be careful. Like when I do that, I do it very short term. Now, AVGO is a good example because they have 3-day-a-week expirations. So not all stocks have expirations 3 times a week. Several of them, most of them are weekly, right? But the ones that give you 3-day expirations every single week, it makes it a little bit more flexible for you. So it's very, very short-term windows. And then I like you said, a very good point, ET Phone Home. Choose a strike price that's pretty far away from where it is, because you don't really want to get rid of those shares and recognize that loss. But it still lets you kind of like, just churn some income for yourself, on an ongoing basis. Would you sell a covered call over earnings? Yeah, man. And I think it was you, Noodle Brains, that I responded to recently. And I'm going to show you here if you haven't had an opportunity to check it out yet. Earnings, I look at earnings as like one of the best opportunities. Now earnings means this, right? Every quarter, like companies will kind of, publicly say, okay, where have we been? Where are we going? What have we made for money? That kind of thing. So earnings gives information, right, to the investing public and generally the shareholders that are invested in that particular stock. And during earnings, right before earnings, the volatility increases, and sometimes it increases pretty significantly. We saw that last week and the week before. I did a lot of these videos on Bloom Energy. Oodles and oodles. How many? Raise your hand. Throw me some hearts in the chat if you've made some money on Bloom Energy recently. Like that stock has had 300% implied volatility with fat premiums. And so earnings, because it gives us higher premium because the volatility is higher, but with the volatility being higher, we don't know if it's going to go up or down. So you have to be careful. So do I look at guidance? No, I'm not looking at guidance. Listen, all those people that are talking about analysts that talk about stocks, they're biased. They're paid for certain things that they say. The investment industry as a whole is, if you don't already know it, is pretty, I don't want to say corrupt because maybe that's a harsh word, but it's certainly, the deck is always stacked against the retail trader. I mean, and that is a fact. That's a fact. Lorena says definitely BE has been awesome. High five. Props to you, Lorena. Good job. And so when we talk about earnings, okay, we have this enhanced volatility. So how do we know how we can make a trade with low risk? Because listen, anybody can make money. You don't have to be good or smart or know what you're doing to make money if things are going up. That's why risk management is so important. So when we talk about risk management, let's just run a scan. So this screener is amazing. There's nothing in the marketplace like this. So I'm going to run a scan. It takes a minute to come back because it is searching the entire universe of tickers. And what it's doing is saying, okay, well, what are all the tickers that have earnings in the next 2 weeks? Because that's when the volatility is the best, right? And then I built logic into this screener that says, okay, well, give me the best trades. I don't want to lose my money, and I want to make money at the same time. But most importantly, I don't want to lose money. So it comes back with a whole list of here's some good trades. It's still running, by the way. I can also see trades that didn't make the cut and click into there if I wanted to see why they didn't make the cut. But unchecking this box to show skips will show all the best trades, right? So I'm going to click into one as an example. I'm going to click into, I don't know, let's use DoorDash. I don't know, or actually that clicked on Expedia. Hang on a second. Let me go back to DoorDash because that's kind of interesting. I'm not a big Postmates, DoorDash kind of person. ordering food and having it delivered. It's very convenient, but sometimes like I can't stand when people mess up my order. And I also prefer to cook. But DoorDash is kind of an interesting stock. So it tells us a few things. And here's an example, right? So this is just an example. Everybody needs this, man. If you're trading and you got money in an account and you're not using tools like this, you are doing yourself a disservice. And I'll just say it like that. Let me know in the chat, who uses this app? Raise your hand or throw up some hearts. Who uses this app? And tell me the best thing that you like about this app. And be honest, because like I have thick skin. Like if you've used this app in the past and you think it sucks, tell me. Like I'm open to criticism, but I want to hear like your honest opinion. Like what is the most amazing thing? Because there's a lot of amazing parts to it, but this is by far one of the most amazing parts. And I'm going to walk through it with you right now. So as an example, DoorDash. They have earnings coming up on August 5th. So that's like in a week, not even a week away, right? So a couple of things. It shows you what is the anticipated move. What does the market expect this stock to move? So, and that's just basically numbers. Now, you could get this information and build all this stuff yourself. Good luck to you with that. Or you could just use this and click into it on the fly and just see everything. So this is telling you the market is expecting a 10.79%, up or down, because volatility can go up or down, right? We don't know exactly which way. And then we also want to see, okay, well, if the market anticipates 10%, where has it been historically? So historically, it's been 6%. I always want this number to be positive. So that's always a green number. That gives you the edge. And this DoorDash is showing up in this list of best trades to look at, partly because of this, and partly because of a couple of other things that I'm about to walk through as well. But you want this number to be green. What that means is like the market is anticipating a bigger move than what it has historically done. That means you're paid more for the risk that you're taking. Listen, you're option sellers. You want that advantage, right? So number one. Number two, we want to look at where has it gone the past 5 years, because history often repeats itself. We learn from looking at history. That's a fact. Not just with trading, but with everything, with life in general. We learn from history. So we can see here, over the past 5 years, it's gone up more times than it's gone down. So that's a good thing. So this always has to be higher than this to like make the list, you might say, right? And then it gives us a few other things, like what's the best day, what's the worst day, because we want to see like what's the worst case scenario that's likely maybe going to happen, right? If we want this information, we can look at it by quarter. I personally don't look at this, but this is for sometimes people are OCD or like analytical kind of people. They want to see all the data, right? All the details. So you can look at that. Me personally, I don't look at that. I look at this box. What is the trade recommendation? Now this is like the golden goose, right? And here's why. Because if the market anticipates a 10.79% move, and we want to sell a put on that particular ticker, we want to put our strike price underneath what the anticipated move is. And the reason for that is because, all things considered, the best opportunity or the best scenario outcome is that we sell a put and then we don't have to buy the shares, right? That's the best outcome. That's the most ideal scenario to be in. I'm committing to buy shares, but the stock never goes down. I don't have to buy the shares. And thank you very much. I kept your premium. And to give you guys an analogy, it's kind of like this. It's kind of like car insurance, right? Car insurance is probably the best analogy to use. So here's a great analogy. I pay a shit ton of money in car insurance. I have a bunch of tickets. My son had a few accidents. We drive nice cars. We live in Los Angeles. We pay a lot. So the best opportunity, I think I'm paying like $2,000 a month. It makes me nauseous even saying that, a month for insurance. It's fucking ridiculous. I think it would be cheaper for me to take an Uber Black everywhere. I don't know. I'm kind of considering that. But the best scenario for the insurance company that's selling me insurance is that they collect my $2,000 every month and I don't have an accident. Like that's the best scenario, right? This is the same thing. The best scenario for us as option sellers is that we sell puts on stock that we like anyway, but the best case scenario is it doesn't go down and we don't have to buy the shares. So that's what this box is showing us. if we put a trade in, what expiration date, because it uses logic to help us identify. A lot of this stuff can be, okay, well, what strike price do I choose? What ticker do I choose? What expiration date do I choose? This helps you do that. Now you got to use your own due diligence, right? You got to make your own decision, but this helps you kind of get an idea for a trade. So here's the idea for this particular trade. Sell it on August 7th, 172.50 put. So it's lower than where it's at, and it's lower than this implied floor that the market's giving us. How much money do we get paid? Well, this contract is trading at 263. That means $263 gets dropped into our bank account, our brokerage account, right when we make the trade. We're not buying a stock, hoping and waiting and praying for that to go up to make money. No, we get paid right away. Instant gratification, right? How much money do we need? Well, on this particular trade, if we're not using margin, we need $17,250 because we're selling a 172.50 put, right? So each contract is 100 shares. So we need 17K to back that up. Now we could also use margin. I talk a lot about margin in other videos. I'm not going to go into detail here, but if you put up all the cash, you need 17,000. Now we don't want to look at just raw premium. We don't want to look at like, oh my gosh, that's $263. Let me take it, right? No, we want to look at this number here. What is our annualized rate of return? Because that lets us compare apples and apples, like one ticker versus another ticker, that kind of thing. So this number you have to be okay with. Now sometimes people say, well, Michelle, what number do you look for, right? There's no like black or white, right or wrong kind of thing, but generally I'm looking for something that's going to make over 50%, right? Because I want to make coin on my trades. I know that I have risk in the market, and I want that risk to be justified, and I want to make a high rate of income. It's interesting. I was meeting with a potential one-on-one mentee the other day. He hasn't come on board yet. I don't know if he's decided to or hasn't, and that's not even relevant. But as I was meeting with him, we were talking about like expected rates of return and, what can you anticipate, that kind of thing. And prior to my meeting with him, I had gone through realized gain loss because you could see that here in the app, right? And I have simulators where I can see the positions. Everything's read only, by the way. So it's all read only. There's no write capability when you connect your brokerage. It's super, super safe. Same encryption the banks use. But the advantage of that is I can do a couple things. Number one, I can see if you have positions that maybe aren't that good. And sometimes I've sent somebody an email, hey, like you're long a whole bunch of calls. Did you mean to do that, or did you intend to be short those calls? So I've helped people like that. And then I can also see like how well they're doing, right? And I have a lot of mentees, actually a few of them, that were making like $16,000, $17,000, $18,000 the past month in realized gains. And the way you do that, the way you get a higher rate of return is by doing this, choosing stocks or choosing trades rather, that give you a high annualized rate of return. Lots of you guys don't calculate this annualized rate of return. If you don't calculate this and you're putting trades in, I'm telling you, you're like throwing a dart, like you're like this and throwing a dart at the wall. Don't do that. Like you have to be educated to make the most like educated decisions. This does not take a long time either, by the way. I'm all about the easy way. I'm not about like, let me get out a spreadsheet and let me go take an Excel course so I can understand how to do that. No, that's why I created this app. That's part of the reason why, because I wanted to make it easy as possible for people. And so you can do that. And let's say you're already thinking of a great trade. Let's use Bloom Energy since BE has been like a lot of the hype. Let's go into the trade builder, right? So let's go into the cash secured put, and we're going to look at Bloom Energy, and let's see what kind of premium that's paying as an example. And then I'm going to go through your questions after. We're not going to look at tomorrow because it's kind of short term. Let's look at next Friday, right? Now, Bloom Energy right now is trading at 209 per share. We can see that number here. So I want to kind of go far away from where it's trading, right? So let's look at, a 180 put. that has a delta of 21. It's only 21% likely. Now, that's not a black and white number, and that number fluctuates, right, based on market movement. But it gives us a good sense of like how likely is that stock going to end up being in the money where we have to buy that stock, right? So and it pulls up all the info for us. We can look at the bid price, we can look at the mid price, we can look at the last price. I'm going to give you like more conservative, worst case scenario. Let's look at the bid price, because that's the lowest price that you would get if you sold this contract, as an example. So now this is just an example. So again, Bloom is trading at 209. If I was to sell a 180 put that expires next week, it would have to drop 13%, right? 13.9% to require us to buy those shares. Now, how much is this contract paying? $590. $590 gets dropped into our account right when we make the trade. How much capital do we need? $18,000 if we're not using margin, right? What's our annualized rate of return? Man, it's 150%. So when I'm going back to that call that I had with this guy the other day, when I was saying, oh my gosh, I have a lot of like users that are making like 15, 16, 17, 18K per month on, let's say, a 300K portfolio or something. And he was like, wow, that's like a big number. The reason why you can do numbers like that is because you're making trades like this. And this app helps you find those trades. Again, it's not about like making money. Most of it is risk. So as an example, if you're using margin, or even if you're not using margin, I have an amazing scenario simulator. Like let me put hypothetical drops in the market and let me see what that does to my account. Like what becomes in the money? What do I have to buy? What does that do to my cash? What does that do to my market value? So we can kind of like, skim through this and look at that. I can also look at, okay, let's not look at that. Let's look at what if it goes up? How does that look? Where does that put my cash? Where does that put my account value? Where does that put each position? So I can kind of go through that, line by line. It's amazing. It's absolutely amazing. Okay, so I think that answered your question, Noodle Brains, about covered calls. I learned about lot matching from your channel. It's great learning. Yeah, lot matching is something that people don't do, and that goes back to you don't know what you don't know, and so it's important to pay attention and learn. Listen, I'm a big believer in learning. Right, I put up a new bookcase over here. I'll show you guys over there. I'm all about books. So I have like books here. I have books on my Kindle, like ebooks that I read. I have audiobooks that I listen to. I'm a lifelong learner, because if you're not learning, you're going backwards, and that goes not just for trading, it's in general. Lorena says definitely BE has been awesome. ET Phone Home says glad with BE, just as long as I don't get assigned. BE at 208 today. Yeah, but you can't be afraid of assignment. So here's the thing that I would kind of like add on to your message, ET Phone Home, is that if you're making a trade and you're afraid of assignment, then that's probably perhaps the wrong trade to be in, because you don't want to set yourself up for a scenario like that. We don't know where the market's going to go. We don't know where the stock's going to go. Like, just because it's been like a rocket ship and a lot of volatility, not really a rocket ship because it's come down a lot lately as well, but just because you can make a lot of money and the volatility is super high, that doesn't, and the rate of return is high, that doesn't mean take the trade. The most important thing to take the trade is the dollar fits in your portfolio. So if you're selling, let's say, a $200 put, right, on a stock, let's say BE as an example, man, you got to have 20K to back that up. And you don't only have to have 20K, you should have like 60K as an example, because you want to be able to sell another put if it goes lower. I mean, that's how you make money long term. It's not about like, let me just put this one trade on and like throw shit at the wall, right? No, that's not how trading is. I mean, you could do it like short term for that, maybe. Like, anybody can be successful short term. If you've been trading for a year or a couple years or 3 years or whatever, and you're like, oh my gosh, I'm a rock star and I'm making so much money. I mean, it doesn't mean you're not a rock star. I'm not saying that, but it doesn't mean, like, you got to make sure you have systems and rules and things in place to really like overstand and overcome rather those drops, because they will happen. It's not like if your ticker drops, it's like when your ticker drops, right? Also, I want to make note, somebody had put up a comment in YouTube earlier about, like, this whole holding the bag, and I don't want to buy more shares because it's going down. And then they were talking about leveraged ETFs. Leveraged ETFs don't really work well with this strategy that we're always talking about on this channel, which is sell a put. If you get assigned, it's totally okay. Don't be afraid of assignment. It's totally fine. If you're afraid of assignment, maybe the trade's too big, look at a different ticker, right? So Bloom Energy is not like the holy grail. There's tons and tons and tons. You can run this, the Earnings Edge, what I just did before, run this screener, and you can sort by price and find other trades that work really, really well that aren't as expensive. So you wanna make sure that you understand that. But leverage ETFs are not meant for that. They reset every day. It's not just 2-3x the underlying. It's a bunch of stuff that's in there that you don't even see, you don't even understand, and you don't even realize what's in there. So just know that ahead of time. These strategies work for good quality stocks. So that's like the most conservative way. Like, what's a good quality stock that I like, that I'm totally okay owning if it went down, and that I would hold that perhaps for long term, and I would want to buy more shares if that price goes down. Because Warren Buffett says it the best himself. If you like the stock at $100, man, you better like it at $80. And if you don't, you're trading the wrong stock. Because usually, like 99 times out of 100, there's nothing fundamentally different about that company, right? When the stock price goes down, that's the nature of stocks. They go up and they go down. It's what they do. It's like I don't know, like my dog barking. It's like a thing that the dog does, right? It's nature, right? So that's the nature of stocks. Noodlebrain says that scan looks good. I will try that trade in my paper account. Yeah, do that. Just get practice. Get your feet wet. Just get practice and that kind of thing. And check out the app, man. 7 days for free. So 7 days for free, $100 a month. If you're trading with real money, if you're trading in a paper account, maybe it might not make sense to justify an expense. Perhaps, I don't know. But certainly if you're trading in a real account and you got real money on the line, man, it makes your work more efficient. It makes you see things that you can't see otherwise. And spending $100 and if you can generate a few hundred just off of that, tool, makes a whole lot of sense. Cool. So any other questions? Today's kind of a quiet day. Let me know also, these live streams are a big commitment. Every day for, 30 minutes, an hour, whatever, is a big commitment for me. So let me know if this is helpful, or, if there's other things that you'd want to see. I'm thinking about perhaps changing the way this live stream runs, because of the commitment. I don't know, just giving that some thought. Thank you for coming and paying attention. Come back tomorrow. So tomorrow's Friday. Friday's the best day of the week. Generally, I like Fridays and I like Mondays. Those are my favorites. Fridays, you have stuff expiring, that kind of thing. And bring your questions. And in the meantime, I want to say thank you and happy trading, as always, right?